A cancer diagnosis does not stop you from selling a life insurance policy. It usually raises the price, and when a physician certifies a life expectancy under 2 years, strong cases sell for 50 to 80% of the death benefit. That runs against everything else a diagnosis does to your finances. New coverage becomes much harder to buy, yet the policy you already own gains value, for a reason that is mechanical rather than personal. Here's why the offer goes up, what it pays at each stage, what buyers actually read in your medical records, and what to check before you sell. Buyers price a policy on life expectancy, not on a diagnosis. A buyer pays you cash today, takes over the premium payments, and collects the death benefit later. The shorter the certified life expectancy, the fewer premiums the buyer expects to pay, and the sooner it collects, so it can afford to offer more. That is the same arithmetic your insurer used when it priced your policy, run in reverse. It also means the timing works differently than most people assume. The moment treatment costs start competing with premium payments is the moment the policy is worth the most it has ever been worth. So if you're close to letting a policy lapse to cut costs, find out what it would sell for first. A lapse policy pays nothing. It depends on where medical underwriters place your life expectancy, and the ranges step up as it shortens. With a physician-certified life expectancy of 24 months or less, the sale is called a viatical settlement. Strong cases price at 50 to 80% of the face amount, sometimes more at the shortest life expectancies. Under Section 101 South G of the tax code, a viatical settlement is also usually free of federal income tax, though you should confirm your own situation with a tax professional. With a life expectancy of 2 to 5 years, the sale is an impaired health life settlement, typically 25 to 50% of face value. Beyond that, pricing steps down toward the 10 to 25% that is typical of a standard life settlement, and every one of those beats surrendering the policy back to the insurer, which typically returns 3 to 5%. Buyers do not price the word cancer. Underwriters read your medical records, the type, the stage, whether it has spread, how it is responding to treatment, and what else you are managing alongside it. There is no exam, and there are no new tests. With your written authorization, your records go to independent life expectancy underwriters, and buyers bid from those reports. Two people with the same diagnosis on paper can get very different offers, which is why a single buyer's number tells you very little. Each buyer models a case its own way, and offers rise when licensed buyers have to bid against each other. A licensed broker represents you, the seller, and runs that competition on your behalf. That is how a case reaches the top of its range instead of stopping at the first offer. 3 checks before you commit. First, look inside your own policy. Many policies carry an accelerated death benefit rider that advances part of the death benefit straight from your insurer, with no sale. If yours does, get that number and compare it against a sale before choosing either. Second, be honest about fit. If your cancer was caught early or is in remission and your life expectancy runs long, the policy prices, like a standard life settlement, and below $100,000 of face value most buyers pass. Selling also means your family gives up the death benefit, and a lump sum can affect need-based benefits like Medicaid. Third, do not rule yourself out on a technicality. Most states waive their waiting period on newer policies for a certified terminal illness, and even a term policy can often be sold if it can convert. Citizens Life Group put this explainer together. If you want a number for your own policy, the estimate link is in the description. There is no upfront cost.